What if the biggest danger in trading wasn't being wrong? What if the real danger was simply not surviving long enough to eventually be right? One violent move, one night where the world changes while you're asleep. That's all it takes. Why? Because they were never managing risk. They were managing hope. Most traders enter the market with open risk, without realizing their downside has no floor. But professionals think differently. They don't try to predict the storm. They build structures designed to survive it. Today, we break the illusion of easy money and break down defined risk structures, the only architecture that keeps you alive in options trading. Let's dive in. Let's be clear, we are here to win. We are here for the profit, the growth, and the freedom that options can provide. There is nothing better than seeing a trade go exactly where you predicted. But there is a trap. Most people think they are winning when they are actually just getting lucky with too much leverage. They are building a castle on a foundation of sand, praying the tide never comes in. The professional doesn't feel guilty about taking profit. He feels confident because he knows exactly how he got it. This is where defined risk becomes your greatest asset. By choosing a spread over a naked position, you aren't playing small. You're playing smart. You're trading a gamble for a blueprint. You're not a victim of the move. You're the master of the structure. You stop being a gambler and you become the architect. In a standard naked trade, you're gambling on the mercy of the sea. If an asset goes to zero, you lose everything. But in a professional structure, like a vertical spread, you are simultaneously buying and selling options at different price points. Professionals don't hide from risk. They define it. They use the mathematics of survival like this. Here's the secret nobody tells you. While the amateur is staring at a screen in panic, watching his account drop by $5,000, the professional isn't even looking at the dollar sign. The amateur tracks his buying power, hoping it doesn't hit zero. The professional tracks his Greeks. While one person sees a loss, the other sees a shift in Vega. They see volatility expanding, and they know exactly how to price it. They look at theta, calculating the daily rent the market pays them just for holding the position. They don't manage a portfolio of money. They manage a portfolio of probabilities. But professionals learned long ago, survival matters more than excitement. They use a specific toolkit to build what we call bomb shelters. By using defined risk structures like credit spreads or iron condors, you aren't just capping a loss. You are choosing your battlefield. You are deciding exactly how much delta you're willing to fight and how much Vega you're willing to sell. When you stop trading dollars and start trading Greeks, the market stops being a casino. It becomes a laboratory. You aren't gambling on a price move. You are engineering a mathematical outcome. So instead of chasing maximum profit, professionals began building structures designed to survive uncertainty. They don't gamble on hope. They use defined risk. These are trades where the maximum loss is known before the trade even begins. Not after the collapse, not during the panic, before it. Because once risk becomes controlled, everything changes. Your emotions change. Your position sizing changes. Your decision-making changes. Suddenly, survival becomes possible. Defined risk structures give you the one thing money can't usually buy in this business: peace of mind. Now that you understand the architecture of survival, it's time to see the engine that turns this structure into a constant cycle of income. In our next video, we're going to explore the wheel strategy, the ultimate system for building a portfolio that doesn't just survive the storm, but thrives because of it.